Today, the responsible lending debacle. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Now, there's an important Senate inquiry currently running relating to the responsible lending changes which are proposed to be made at the end of March. This, of course, was brought to the fore just a few months ago and was passed in the lower house. But the Senate is looking at it in some detail. In fact, it was on the 10th of December 2020 that the legislation was referred to the Economics Legislation Committee, and the bill itself is called the National Consumer Credit Protection Amendment, in brackets, Supporting Economic Recovery, close brackets, Bill 2020. Now that tells you all you need to know about this bill, because of course what really isn't contained in the bill is some very important changes which essentially skews responsibility for loans from the banks back towards individual borrowers. In fact, it really emasculates any consumer protection within the banking system for particularly mortgages. And I should say this doesn't necessarily apply to business loans. Now, I wrote a submission to the Senate, posted it this evening. Now, I'm not going to go through this in detail because what I've submitted is subject to normal committee processes now. But I wanted just to go through a few of the highlights because there is an opportunity, if you feel really strongly about this, to make a quick submission. Submission close on the 3rd of February, that's Wednesday night. And I know of a number of people who are putting in specific points relating to this rather daft legislation. So what I did in my submission was to essentially highlight the fact that the reforms are focusing in on financial stability, and of course that's the bailiwick of APRA, rather than protecting consumers and making sure that loans are appropriate for consumers. And my argument is that at this time, when in fact credit is growing quite fast, rather than taking away responsible lending guidance, we need probably more of it. And it's also worth noting that the Banking Royal Commission specifically asserted that the responsible lending rules should remain, and we certainly agree with that. So I briefly referred to my core market models and all the analysis that I did, and covered my mortgage stress data. And of course, those of you who follow the channel will know that mortgage stress still is more than 40% of borrowing households. And the total debt ratios in Australia are very, very high, particularly for household debt. I also make the point that the Reserve Bank has quoted the household debt to income at 1.79 times, and it's come down a little, but that's very deceiving because only a third of households are borrowing. That means that the true debt to income ratio is closer to 5.5 times. And in fact, many new borrowers are getting loans at 6 to 8 times income, compared with 3 to 4 times some time back. That is a big deal and is a problem. And then I went on to refer to house prices and made the point that the RBA study recently that I cited made the point that if rates are cut by 100 basis points over 3 years, then you might well see house prices rise 30%. But house prices are already very high in Australia, some of the highest in the world relative to income. And frankly, the last thing we want is more significant house price growth. We'll get that because of ever more credit. And of course, the Royal Commission revealed just how badly banks dealt with the current lending standards. We saw a number of examples of banks essentially lending beyond the standards just because they were chasing down profit, never mind consumers. And I'll also make the point that credit supply is not an issue in Australia, even under the current regime. In fact, the recent RBA data shows that there's really strong lending for housing, with owner-occupied lending growing at 5.58% and rising. And this is a chart that I produced the other day, which just makes that point. And the latest data from the ABS today show that new loan commitments, total housing, seasonally adjusted, shot through the roof, both investment and operate. There is no issue with getting credit. So one of the main reasons that this legislation was put through initially was because there were lots of barriers in the way, quote unquote. Well, no, there are no barriers. People can get credit if they want it. Now, then I went on to discuss the not unsuitable legislation, which of course came post-global financial crisis, when around the world it was clear that banks were not doing the right things to their customers. They were effectively lending way too much. And frankly, that not unsuitable wording that ASIC cooked up was always vague, always difficult to interpret. And of course, recently with the Westpac case, the judgment was that, well, banks could use whatever benchmarks they wanted to. So frankly, the HEM is a good example of the problem, but the real issue is not unsuitable is a very unclear way of thinking about responsible lending. But my argument is that whilst the banks would love to have that obligation removed, and I have a feeling there might have been some horse trading between lenders who might face class actions under the responsible lending obligations, and the bank's willingness to recently help households and businesses through COVID. And by the way, I'd make the point also that ASIC has been more orientated to consumers and consumer protection compared to APRA. APRA is really only interested in financial stability and the banks. APRA is aligned to the banks and is frankly very narrowly focused on financial stability. But the key point to make, and this is the big takeaway, is if the responsible lending changes were to be brought in, it would essentially mean that households would be on their own. Essentially, whatever you tell the bank, whatever information is presented, whatever loans you want, the banks can turn around and say, sure, no problem. It's your responsibility if it goes wrong. We don't have any responsibility at all. Now, they do have broad financial stability responsibility from APRA, and of course mortgage brokers have best interest obligations now, but nevertheless this does change the field completely. And I also know that in a number of cases from my surveys, households have actually been able to get loans 20 to 30% more than is really sensible. And in fact, in some cases, people have said to me they've backed off what the banks offered them. So we know that there is a tendency for banks to offer more than households are comfortable with. Now, APRA is pushing the banks with regard to risk portfolio management, and that's good. It's necessary but not sufficient. We still need responsible lending. We still need focus on consumers. And indeed, my surveys show that quite often households who've got really big mortgages, because they're chasing higher home prices, can put in some sort of deposit, but then often struggle to maintain repayments. And what happens quite often is that initially it's not too bad, they get into some difficulty, income isn't growing, and they ultimately refinance a couple of times and get into more difficulty and refinance again. And 4, 5 or 6 years down the track, they end up selling the property. If they're lucky, they sell at sufficient value to be able to repay the bank, so the bank never takes a hit. But the consumer, of course, deals with all the worry, financial concerns, social stress that results from that. So we need a better approach. And my own recommendation that I put into my submission was that we need a responsible lending regime to be maintained and enhanced to remove the ambiguity that's currently in the current regulations. And I think there needs to be a clear consumer champion from a regulatory perspective. And it can't be APRA, because APRA is only focused on other banks. And frankly, I think there's a bit of a plot here to detune and frankly emasculate ASIC. I think that's because the government feels they've overstepped their mandate whereas I would argue that they haven't stepped up sufficiently to protect consumers. And generally, my research shows that those consumers who are less able to deal with financial matters themselves, which may well be led down the garden path, for example, a lot of first-time buyers, a lot of socially disadvantaged people who end up with big debts that they can't service. In short, the proposed removal of responsible lending rules, as proposed in the legislation, is absolutely not warranted. So there you have it. In a nutshell, that's what I have said. And I'll be interested to see what the other submissions make over the next little while, as I assume they'll publish them in due course. But as I said, there is still a window of opportunity. So if you feel strongly about this, and I think consumers should feel strongly about this, it's not too late to make your own submission. I'll leave a link to the Senate inquiry below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.